past few weeks have been tumultuous for global markets. Some highly consensus trades have reversed and reversed quickly. For instance, crude fell 48% in the year to April 2015. In the 6 weeks since April 1st, it has risen 15%. Likewise, India was the star equities market in the 12 months to April 2015. It rose 28%. From March 1st this year, it has fallen 9%. The European and US bond yields also demand attention. Since April 1, 2014, bond yields collapsed 133 basis points from 1.47 to 0.16%. In the past 4 weeks, they have climbed 50 basis points to 0.56% from 0.07%. US Treasury yields have also jumped 25 basis points in the last 6 weeks. The euro had fallen 28% in the year to April 1, 2015. Since April 1st, it has shot up by 6%. What is happening in the global economy and in the global financial markets? Is there a reset of fundamentals? Is growth returning? Is deflation over? Should one start buying commodity producers and shun commodity consumers like India? To answer all those questions, I have with me two well-known watchers of the global economy and of financial markets. Jim O'Neill, formerly chairman of Goldman Sachs Asset Management Company, and Manoj Pradhan, global economist, Morgan Stanley. First, Mr. O'Neill. Thank you very much, sir, for joining us. And though I remember you saying last time that you are loath to guess crude prices, that is going to be my first question. Crude prices have recovered about 40% from their December lows. Has crude overshot on the upside? Does it fall? Or do you think it's going to remain at current levels or even be higher?
I think we might have some more to go, actually, even though I always like to emphasize in my discussions with you, I am not obviously as professionally engaged in some of these things as I was for 30 years. And I'm trying to predict oil prices is sort of in the lunatic asylum area. But I wrote something before December saying that I thought oil prices would end 2015 higher than where they ended 2014. And I still think that. I think the big story is that we overshot too much on the downside. And I think not that oil prices will ever stay at the same price for very long at all, but I think the equilibrium price, given the current state of world economic growth and supply, is somewhere close to where we are, maybe a little bit higher than this. So I think the recovery we've seen is really a response to a too big a decline for the fundamentals that took place. But let me emphasize again, if any of us knew where oil prices were really going all the time, we would be living on our own personal Caribbean islands. So
you think crude may average around $75-80 for the remaining part of 2015?
You know, I thought about 5 years ago when oil was 120 that the right price is about 75 to 80. And I have no reason for changing that view. I think it suits many people around the world for oil prices to not be too high, but also it suits many people for them to, particularly the United States, for them to be not too low. So if I had to stick my head out as to the right price, I think it's about 75 to 80. Whether that means that's where we trade is another matter.
Well, the long crude trade has meant short India. But even after this 10% cut in the Nifty from its March highs, we understand that many fund managers are still about 400-500 basis points overweight India compared to benchmark indices. So, should Indian investors brace for more selling of Indian shares?
I think there could be more selling. You know, as you ask the question, I think about it as a personal investor as well as an analyst. I increased my personal exposure to Indian equities about 18 months ago, just as we were starting the campaign for the election. And about 5 weeks ago, after the Indian budget, I actually sold my position because I thought the oil issue was going to be less friendly. And in addition, after the budget, I'm not sure what new good policy news in the near future could happen.
Okay.
And so I think the Indian market has had a fantastic run. It's priced now for a better Indian economy and for better earnings. And I can't really see any upside for the near future.
Well, the other trade that has reversed lately is the long dollar short euro trade. As well, German bond yields that were, falling suddenly shot up. How should we interpret all this? Does euro not fall back to that nearly parity level with the dollar? And the bond yields, are they telling us that deflation is over in Europe?
So, to me, the euro-dollar relationship correction was even more obvious. Okay. Obviously, as many of your viewers probably know, I spent so much of my career in the foreign exchange market. Yes. And one of the few lessons I learned is that you never want to be with a lazy consensus. Okay. And in the first quarter of this year, the widespread shared view that the US was going to grow very strongly, Europe had persistent problems, and the dollar could go up forever against the euro, was almost ridiculous. Okay. And it was very vulnerable to the US disappointing such high expectations and Europe positively surprising such low expectations. And that's exactly what we've got. And let me also add importantly, I don't think from a US perspective it's sensible to allow such a big rise of the dollar, because it's not good for the United States rebalancing post 2008-2009 crisis. So now we have a more sensible market. And my own view is we could spend quite a bit of time between 105 and maybe 116, 117 until we know a lot more evidence as to what is really going on with the US economy, and whether this weakness is temporary, and more and more interest and relevance of the Bund story as to whether in fact Europe is now truly coming out of this fear of being like Japan. One of the ongoing most striking, interesting things in the world is the strength of peripheral economic activity. Just this morning in Europe, we've had much better than expected Spanish and Italian industrial production numbers again. Yes. And I think the markets are too negative about the European economic situation. The crisis countries other than Greece are showing more and more signs of actually having shown some benefits from reforms. And reminds me of another one of the things I've learned in my career is never let a crisis go to waste. Okay. And it looks like these countries have made some positive adjustments.
Well, if Europe is growing and given some improvement in some emerging markets, can we say commodities have bottomed? Will they crawl up for the remaining part of this year?
I wouldn't be surprised. I think, we discussed oil earlier, yes. Where it's clearer to me. For other commodities, I don't have such a strong view, but I wouldn't be surprised if they recover a bit further. We've had a very powerful move down now for about 3 years, and these kind of corrections go on. What I would say is I do not believe that this is the beginning of a large multi-year rally in commodity prices. I do not think that is the case.
Mr. O'Neill, what would be your top 3 picks across equity markets, indeed across asset classes?
Well, luckily, I have no professional obligation to make such predictions, so it's nice not to have that pressure. But I would say, in answer to your question, my number one favourite remains Chinese equities, as it has been all year. Yes. I think investors and analysts are underestimating the scale of China's shift in terms of its own rebalancing, and I think it's very good for consumer-related, what I call consumer-light stocks in China, particularly consumer stocks itself, but healthcare, things to do with education and an improving Japanese society. So I remain very bullish on that. I think what we've seen there in the past this week is just really a correction after this huge rise, but I'm still bullish on Chinese equities. I think after the move we've had in German bonds and the euro, at this level, I think I would also have as probably my second favourite European equities, because I don't think the euro is going to have a huge rise from here. As I said, it could go 115, 117, but I don't think any more than that. And I think the ECB will keep its monetary policy friendly. So I think the European equity outlook is pretty friendly too.
Okay.
They are currently really only the two big views I would have. So I can't really give you five. If I had to give you a third, I would say it seems to me if we're seeing this story in Europe and a correction away from this fear of Europe going down the path of Japan, I have a suspicion that the Swiss franc, as soon as we settle the Greek situation, which at some point we will, I have a suspicion that the Swiss franc could decline sharply because some of the broader reasons why the Swiss franc has been so strong are quickly disappearing.
Coming back to India, the markets have fallen, like I said, about 10%, and valuations have dipped maybe from 17 times to about 15 times. Do Indian equities fall more, or will they just meander at current levels?
You know, at this level, I'd be a bit more inclined to the meandering part of your scenario. It's not impossible that Indian equities could decline another 10 to 15%, given the amount of money that's gone there, and if all the external factors were negative at the same time. But that's not my central guess. My best guess is that we probably do meander around. But I do think, linked to some of the questions you've asked me, and something that really put it into perspective, I was in India about the same time as the budget, but I also, when I came back to Europe, spoke at a very important retail investor conference about the long-term outlook for emerging equities. And somebody showed me a chart of the long-term returns for the 13 and a half years since I created the BRIC acronym. And the scale of India's outperformance relative to Brazil is so big. It made me think that maybe the true long-term investor might want to start thinking about going the other way. So, I'll put it another way, or I'd add to it, to really get the Indian market rallying again, I think Modi and his team have got to deliver more specific things on some of the big reform challenges. And I'm sure at some stage they will. What I would love to personally see in particular is these comments they've made about more independence for the Monetary Policy Council. If they were to go ahead and implement a true Bank of England, say, style Monetary Policy Council, that would be something to get me freshly excited about the Indian market again. But without something like that, it's sort of seen its game run out for now, in my view.
Well, on that cautiously optimistic note, as they say, Jim O'Neill, thank you very much for joining us. We take a short break. Thereafter, the global economist from Morgan Stanley, Manoj Pradhan.